Welcome everyone to a part two of our discussion having to do with, in our first part one we talked about changes to stockholders' equity, and we promised that we would go over some things that you need to know about bonds. Now, so that's what we're going to spend some time on. First of all, we want to make sure we understand some bond definitions. So the first one I like to bring up is what we call serial versus term bonds. Most bonds in real life are term bonds, and what that means is that they pay interest only during their term, and then at the end, the maturity date, they pay all the principal. So at any given time, so if the bond is for $500,000, that amount is going to stay the same through the whole time because you're never paying anything off. You're simply paying the interest. So think of a term bond as an interest-only loan. Serial bonds, which are much more rare, pay interest, but they also then pay off some of the principal each time. So it might be that you have a $500,000 bond. You pay interest every 6 months. Typical bonds in the marketplace pay every 6 months or twice a year. When you pay the interest, you also pay a set amount of principal. So you might pay off $50,000 of principal with each interest payment. That means that your interest for the next 6 months was going to be lower because you've paid off some of what you owed. That's never the case with a term bond. The interest is going to stay the same, the amount you pay, because the amount you owe has not changed. All right? So the payment on term bonds is going to be the same. Serial bonds, the principal will be the same, you pay each time, but the interest will go down as you pay off the loan. So there's your differences. We will focus, and we did earlier when we talked about present value in another module, we use an example of a term bond. So if you'll recall, we want to go back to our review of present and fair value. We looked at the value and used the present value function in Excel to calculate the value of term bonds. That would not apply in the same way to serial bonds. They would have to be a little different because the amount of interest is different each time. Term bonds, it's the same, so it works with the present value function. Second definition I want you to be able to differentiate between is secured and unsecured. This refers to collateral, or whether the bond has collateral. Remember, a bond is borrowing money. There's an agreement between the borrower, the company, and the investor, the buyer of the bonds. And what happens if the company can't pay the bonds? Then, as we might think of in typical loan, there is collateral, and that allows the lender to repossess the collateral if in the event of non-payment. Most bonds are unsecured, but there are some secured bonds out there, and they're going to have a lower risk, so that because the lender knows they can at least get the collateral if things go bad. So they're going to charge a lower interest rate on secured loans versus unsecured loans or bonds. And if you want an example, personal example, think of the interest rate on your credit card you use, which is unsecured, meaning credit card company can or bank cannot collect the collateral or the stuff you bought with your credit card if you don't pay. But compare that interest rate to that on your car loan or home loan, both of which have collateral or secured loans, and if you don't pay, they can repossess either your car or your house. So The next one, we talked a little bit earlier in part 1 about convertible, the idea of converting bonds into stock. That's another thing to pay attention in terms of bonds, is whether they're convertible or not. Again, most bonds are not convertible, but there are some out there convertible, and they're going to pay a lower interest rate. The company's going to pay a lower interest rate by giving investors that conversion feature. So if it has a value, that conversion feature, then you don't have to pay them as much on interest. And then the last term is we want to refer to as callable. Bonds typically are not callable, which means you cannot pay them off early. Now, bonds often trade in the marketplace, meaning just like stock. So I could buy a bond that is actually loaning money to Ford Motor Company, and I buy that bond from another investor who had bought it from Ford, or could have bought it from somebody else that was an investor before them. All right. If Ford wants to pay off all their bonds early, they could go into the marketplace and offer each one of those buyers, each one of those investors, money for the bonds. And that might work to an extent, but there will be some people that will not sell. No matter what you do, they're not going to sell, no matter what you offer. And so, in fact, they may not even know you're offering, because they bought the bond and then they've stuck it in their brokerage account and forgot about it. Callable bonds allow the company to contact and pay off everybody, and you have to accept their payment. You cannot say no to the payoff early option. So that's what it means to be callable. They're going to call the bonds, pay it off early. Usually there is a premium. So if it's $1,000 bond, the premium may be, say, 5%, which means they would have to pay $1,000 plus 5% of $1,000, $1,050, to compensate you as an investor for having to give them the bonds early, or give up your interest rate that you are earning on those bonds. So callable usually involves a call premium. If you call your bonds, your journal entry is going to look like a credit to cash, a debit to bond payable, and then a debit to either gain or loss based on how much you pay versus how much is listed as the carrying amount. And we'll talk a little bit about the discount premium on these bonds in a minute. But before we move on to that, I want you to see this next slide. This is a list of bond quotes. So this is Ford Motor. This is the interest rate that they pay on those bonds. This is how you would calculate the amount you would receive. Bonds are always quoted as $1,000. So everything is based on one bond being $1,000. And if you want to borrow $500 million, you just divide it up into $1,000 increments and sell however many you need to get to $500 million. This is the yield to maturity. So if you buy the bond and you hold it for the whole time, you will make this much money as an investor. This is a bond rating. This rates how risky the bond is. The least risky is A. This is Baa2. So it's not just A, B, C. Okay, they've split it up into very small increments, A minus, so forth, AAA, AA, single A, BAA, all this kinds of things, so that they can be very specific. So Ford Motor Company has a rating of Baa2, which is not too bad, but not too good, kind of in the middle. This is the maturity date. Notice some of these go out clear till 2097. All right, where most of us will be dead. Okay, but you can see that some of them go a very long ways, and some of them are going to mature very soon. All right, these are prices. This is the bid and the ask. This is what people are buying or selling these for in the marketplace at any given time. Specifically at this point in time, this is a couple of days ago, and this is the prices that were happening. So how does a bond that is paying 7.4% only make 5.72% to the investor? Well, because they don't pay the face value. They pay 121.72. This is the present value of the future cash flows. So remember when we talked about various fair value, to get the fair value of anything, you get the present value of the future cash flows. Well, the cash flows are determined by multiplying 7.4% by $1,000. Always. 7.7 times $1,000. 6.625 times $1,000. That's your cash flow. All right, and if it's every 6 months, which these are, you divide by 2 and you get that much every 6 months. But when you put it into the present value function or calculation in Excel, this is the interest rate you put in. This is the market rate. And what you'll get is this value. So if the price changes, that means that this interest rate is changing. That's the thing that I want you to remember. These two work opposite directions. This is going to go up as this goes down and vice versa. So this is the rate that you're actually earning by paying 121.72 and then getting the cash flows at 7.4%. And this, by the way, is $1,217.20 on a $1,000 bond. So it's always as a percentage. These are always quoted as percentages. All right. So in the market, you're looking at what percentage. The price is always given at a percentage of the face or the maturity value, as we just saw. And the other piece that people are interested in is what yield to maturity. So these work together. So at any point you could use present value and calculate. If you knew the yield to maturity, you can calculate the price. And if you know the price, you can just keep guessing what the yield to maturity is until you get that price, because you always know what the cash flows are. Now, when you sell bonds, you figure out the present value of the future cash flows based on the market rate that you are given. And that's the rate that people could get on other bonds similar. If that happens, you'll get the debit, cash, credit, bond payable for the maturity value, and then you're going to either record a discount or a premium. Discounts are debits, premiums are credits. If you receive more cash than the face value, it's a premium. Less cash, it's a discount. So that's how you record it at the time of sale based on the present value of future cash flows. That becomes your carrying amount. The carrying amount or book value is the face value plus the premium or minus the discount. Now what happens over time as you pay these bonds, remember you're paying, these are term bonds, paying interest only, you have to get rid of the premium or discount. There are two ways to do that. One, straight line, which means you'll make the same journal entry for every payment, just like straight line depreciation. You'll simply take the premium or discount, divide by how many payments you're going to make on the bonds, and you're going to record that amount every time you make a payment. So if you started with a premium, you're going to debit premium for that amount each time. If you start with a discount, you're going to credit discount. So you see what's going to happen? That discount is going to disappear over time, or the premium is going to disappear over time. And it'll be completely gone by the time you reach maturity. All right? Effective interest rate method, which is actually required under GAAP, it means you're going to have the same interest on the carrying amount each time. So you start with the original carrying amount, which is your face value minus the discount, let's take as an example, and you multiply that by the effective interest rate, which is the yield to maturity or the interest rate in the market. That becomes your interest expense. You debit interest expense for that. You credit cash. Cash is always the same. Cash flows regardless of what method you use, and the difference is going to be either a reduction of the discount or an addition or reduction of the premium. So you use the same accounts, just the amounts are different in these two methods. What if there's a change in market interest rate? That changes the fair value of that bond, as we saw earlier in earlier examples in our other module, but it does not affect what we're doing in terms of the current payment. The payment is not going to change on term bonds because they stay the same.